Before the great financial crisis, bank capital regulation was mostly ruled by the set of agreements called Basel II, and one of the pillars of Basel II was the so-called capital requirement that stated that at any point in time, capital for an individual bank should exceed a certain fraction of the value of that bank's assets. Then the great financial crisis happens. Regulators from all around the world think, okay, these didn't work. We need to rethink the way that banking regulation works. So they come up with this set of new regulations, collectively known as Basel III. And one of the pillars, one of the new things that Basel III introduces is this counter-cyclical capital buffer. That looks a lot like the old capital requirement, with the key difference that this kappa, this fraction of assets that need to be financed by bank capital at any point in time, is now allowed to be a function of the state of the economy. And the BIS, the Bank of International Settlements, that kind of like coordinates the Basel III agreements, as these recommendations that are relatively vague on purpose, I guess, that recommends national regulators to raise these kappa during periods of quote unquote excess aggregate credit growth, whatever that means. And before, obviously, recent events have completely appended anything that we kind of knew and took for granted in terms of financial stability and bank regulation. But before COVID, these excess buffer during periods of excess aggregate credit growth was active in some important jurisdictions, such as France, Hong Kong, Sweden, the UK, or Norway. So in this paper, I'm going to try to answer two questions. First, in a nonlinear new Keynesian model, where there's scope for macroprudential policy. And number two, I'm going to take that model that I developed, I'm going to calibrate it to the US, bring it to the data, and ask the following question. Could these type of regulation have prevented the 2008-like crisis in the United States? The way I'm going to approach these two questions is as follows. First, I'm going to develop a nonlinear model where financial crises are endogenous. By these, what I mean is that the economy is going to endogenously, depending on its endogenous state variables, is going to enter and exit regions where crises are possible. These crises are going to trigger aggregate demand recessions, much in the style of Mian and Sufi. There's going to be scope for macroprudential regulation in this model, and the model is going to feature strong interactions between household and bank balance sheets. So it's going to be a model of the 2008 crisis in the United States mostly. Then I'm going to take that model, bring it to the data. I'm going to calibrate it to the US economy in the pre-crisis period. I'm going to combine it with time series on macro and financial aggregates in order to estimate structural shocks under Basel II. So there was no CCYB during the financial crisis in 2008, so I'm going to estimate the shocks that quote unquote drove that governed the behavior of the US economy during that period. Then I'm going to take those shocks and I'm going to feed them into a model where the regulator has access to something that looks like the CCYB, and I'm going to ask what happens then? What happens in that counterfactual economy? And this is a summary of my results because I'm going with probability 1 run out of time. So in terms of my first question, what are the quantitative effects of the CCYB in a nonlinear New Keynesian model? I'm going to find that the CCYB has both ex ante benefits and ex post benefits. And by these, what I mean is that ex ante, the CCYB is really going to be macroprudential in the proper sense of the word. It's going to reduce the ex ante frequency of crises by about 60%, by more than half. But it's also going to have some ex post benefits in the sense that conditional on the economy entering a crisis, the economy is going to be better off if the CCYB is a thing. In fact, and this happens because the CCYB is going to reduce bank leverage across the board in all states of the world. So even if the economy enters a crisis, it's going to enter the crisis with a better capitalized banking system. And this is going to reduce the severity of the crisis by about 20% in terms of peak to trough change in GDP. In terms of my second question, could the CCYB have prevented something like the 2008 crisis in the United States? My results seem to suggest that yes, it could have prevented a large financial panic in 2008, but it couldn't have prevented the subsequent recession. And this is but basically it suggests that it could have allowed the US economy to to experience a soft landing onto the Great Recession. And I'm going to find that the whole mechanism through which a CCYB has real effects is mostly precautionary. So again, it's really a macro-prudential policy in the true sense of the word. And this has an interesting feature that it basically says that the CCYB might not have to be used in equilibrium. So just the fact that the institution exists and the threat of the regulator raising capital requirements for banks is there means that banks are going to adjust behavior in such a way that the regulator might never have to actually do that. And I thought that was something cool that comes out of the paper. I'm going to skip the literature, very short presentation, and I'm just going to give you a very brief overview of the model. The model, unfortunately, is kind of complicated. I'm sorry for that. So I'm just going to give you a very brief overview of what are the key ingredients of the model. And if you're interested, we can talk later or you can read the paper. But there's going to be basically 4 key ingredients, quote unquote, frictions. There's going to be household default. It's actually easier if I show you the diagram. So there's going to be 2 types of agents. I would love to have a full-blown heterogeneous agent model, but I want to talk about financial crisis and aggregate risk and the nonlinear effects of those things. So I have to stick to 2 agents. There's savers and borrowers. Borrowers like to buy houses. In order to buy houses, they borrow from banks. These banks are going to be subject to a series of financial frictions. First and foremost, they cannot issue equity. So they have to finance these loans with either retained earnings or deposits that they borrow from the savers. And they're also going to be subject to capital regulation, and this is going to be important. And finally, these banks are going to be subject to runs. So the economy can endogenously enter these regions where a run becomes possible, and this is going to depend on the endogenous state variables. And if a run happens, basically you have intermediation between savers and borrowers breaks down. And that's going to be, so the economy might find itself in a situation where borrowers would like to borrow, they cannot, because they cannot borrow, their consumption has to fall. And that's where the final big friction enters. There's going to be nominal rigidities in this model. So borrowers want to borrow, they cannot, their consumption falls. Because of nominal rigidities, this is going to lead to a fall in aggregate output. So this is how financial crisis in this model leads to aggregate demand recession. But I think the most important things that we know about borrowers, I kind of said them already. They borrow in long-term debt, they purchase houses. There's going to be they can default on those mortgages, and this default is going to be fully endogenous. And the equilibrium policy rule for default basically says that default is going to be an increasing function of household leverage. So if house prices are low, they default more. If they're borrowing more, they default more. And importantly, their borrowing is going to be subject to borrowing constraints, to LTV constraint on the borrowing. This is also going to be important because it's going to make their marginal propensity to consume fluctuate over the business cycle. Now, the second key and complicated ingredient of the model are going to be the banks. If you're familiar with the work of Gertler and Karadi, banks are going to be somewhat similar. So basically, this is the program for an individual bank. The key state variable is going to be earnings, that I call little et. So the value, what's the value function of the bank? The bank is going to choose how much to borrow, how much to lend in terms of mortgages, dt, and how much to borrow in deposits, dt. The payoff today is going to be the dividends that the bank pays, and this is going to be one of the key frictions. I'm going to assume that the bank is forced to pay a constant fraction of its earnings as dividends every period. I have extensions of the model where I relax these, not super important. So the current payoff, the dividend, and the future value. And the future value, there's going to be SDF here. That's the SDF of the owners of the bank. And there's going to be a max operator, which already suggests that banks are going to be able to default and there's limited liability. So if next period the bank wakes up and its value is negative, it just walks away from everything. And the bank is going to choose how much to lend and how much to borrow, subject to 3 constraints. A super simple balance sheet constraint. The value of assets have to be financed with either retained earnings or deposits. Important, capital requirements. So the bank needs to finance a fraction of its assets with its capital at any point in time. And the law of motion for earnings. That just tells you that earnings next period is whatever comes out of the assets minus whatever you have to repay in terms of deposits. Now, if I do some algebra, I get a series of results that allow me to understand a little bit better how the bank problem works. In particular, it turns out that the value function of the bank is linear in the state variable in bank capital. So basically a bank defaults, I showed you before, a bank is going to default if it wakes up next period and its value is negative. This is going to be equivalent to saying the bank defaults if its earnings are negative. So basically, if it doesn't have enough resources, if its investment on assets is not enough to repay all the depositors. very important assumption. I'm going to assume that if banks fail, assets have to be sold at some exogenous liquidation cost on the D. So there's already going to be endogenous liquidation costs because these RTV, the payoff from the assets is going to be an endogenous state variable. It's going to, not a state variable, it's going to be an endogenous variable. But on top of these, there's going to be an exogenous liquidation cost. If the bank fails or if the bank is liquidated, it doesn't get the full return on its assets. It only gets a fraction 1 minus lambda of these. And this is going to generate these multiple equilibrium issue where there can be runs in this model. And these runs are going to be possible if banks are solvent but illiquid. What this means is you can have situations where if depositors decide not to liquidate the bank, then the bank might have enough resources to repay all of those depositors. So the bank is fundamentally solvent. But if all depositors decide to coordinate and liquidate the bank, then the bank would not have enough resources to repay all the depositors. So this is a situation where there can be multiple equilibria. And so from the point of view of a depositor, it might be optimal to run or not to run, depending on what all the other depositors are doing. Very classic Diamond Dybvig 1983 problem. So I'm going to assume that there's a sunspot that's going to coordinate the depositors. So whenever this sunspot lights up, which it does with the constant probability, there's a run. If it doesn't light up, there's no run. Then I can also show that there's an aggregation result. This allows me to only work with the representative bank with equity equal, with its earnings equal to aggregate earnings of the banking system. And then doing some more algebra allows me to define these thresholds for crisis and insolvency regions, that because I only need to deal with the aggregate bank, with the representative bank, these things are only going to depend on the aggregate state variables, total household debt in this economy and total deposit debt in this economy. And these thresholds are going to depend. So basically the only thing I want to highlight from here is household debt and deposit debt are going to be endogenous state variables in this economy. So they're going to be moving around depending on the exogenous shocks that hit the economy. And they're going to define thresholds that in turn are going to define whether the economy whether the banking system is subject to a run or not. So whether this aggregate representative bank finds itself in a situation like this or not. So the rest of the model is very standard New Keynesian. There's going to be 3 aggregate shocks in this model. TFP shock, super boring, does whatever you expect the TFP shock to do. There's going to be the sunspot shock that, as I just showed, is going to determine whether the economy is in a run, is hit by a run, if it's in the run region or not. And then there's going to be a funding cost shock, which is something very small and it's just useful quantitatively to match some time series. And the way that financial crises become aggregate demand recessions in this model is as follows. So I showed you from before that basically if bank leverage is high, so if deposits to household debt are very high, the economy might find itself in a run region and might be subject to a run. So depending on the realization of the sunspot. So if there's a bank run, what happens? Bank capital is going to collapse, which because of the capital requirement is going to mean that lending will have to fall because lending needs to be financed by capital. At the time that LTV constraint for the borrower starts binding, then this will mean that the MPC of the borrower is going to be very high. So changes in income will translate themselves almost one-to-one to change in consumption for the borrower. Now, the fact that lending is falling and spreads are going up.
10 minutes left.
10 minutes left. Thank you. Perfect. Now, if lending falls and spreads are going up, these two things will effectively mean that disposable income is falling for the borrowers. And if their MPC is very high, it also means that their consumption is falling. And as consumption falls, house prices are also going to fall. This is going to lead to a rise in defaults, which is going to hamper the recovery of bank capital in a persistent manner. And the important thing is that because there's nominal rigidities and there's incomplete markets, and so MPCs are different between borrowers and savers, this fall in consumption for the borrowers is going to lead to a potentially large fall in GDP. So as I said at the beginning, this is a very Mian and Sufi-esque model where you have these financial crises that lead to demand-driven recessions. This is what the state space of the model looks like. So in the x-axis, there's basically bank leverage, or you can think of these as bank deposits. On the y-axis, we have household debt. These are the key endogenous state variables of the model. Here, this intersection of the black dashed lines is just the stochastic steady state of the model. These are the 3 regions I talked about. So if bank leverage is not high enough, then the economy is safe. So regardless of the realization of the sunspot, there's never a financial crisis. Then as bank leverage increases, the economy might find itself in a run region where depending if the sunspot lights up, then the economy experiences, the banking system collapses. And then if leverage is sufficiently high, there's also an insolvency region, not interesting because the economy never goes there. It's a region where the banking system fails regardless of the realization of the sunspot. And these what the regions look like for a high realization of the TFP. As I told you before, depending on the realizations of exogenous shocks such as TFP, the endogenous state variables are going to be moving around. So these regions are also going to be moving around. So here, as you can see, if the economy finds itself at the stochastic steady state in terms of the endogenous state variables and TFP is high, the economy is clearly in the safe region. But if TFP becomes low, all of a sudden, for those same levels of fossil debt and bank leverage, the economy might find itself in the run region. So depending on the realizations of these exogenous shocks, we might kind of like take the rug from under the economy as the economy moves around, it might find itself entering the crisis region endogenously. I calibrate the model to the US. I don't have time to talk about the calibration, but you can check the paper. Simulate the model for many periods, focus on the periods when a crisis happens, take medians for the path of certain variables during these periods. Only thing that I want to highlight here is that these crises kind of look a little bit like the Great Recession in the United States. So you have like these large collapse in borrower consumption, large drop in house prices. This also leads to a large fall in GDP and a large increase in financial measures such as bank credit spreads, the difference between the cost of borrowing off deposits and the risk-free rate. Another interesting thing that the bank does is precautionary motives are so this model is solved non-linearly, full global stochastic solution. Precautionary motives are very important. There's these really interesting, what I call almost crises, which are situations where the economy enters the run region, but exits that region without a run ever happening. So you have these situations where the economy enters the run region. A run might happen at any point, but no run ever happens. And the economy successfully exits. Even just like entering the crisis region generates a recession in this economy because people freak out and think that the run might happen, even if no run ever happens. And here what I show is that there can be quite sizable effects from entering these regions, even if no financial crisis actually materializes. So I thought this is a cool feature of the model. CCYB, how is it going to work in the model? I'm going to set the benchmark capital requirement, the fraction of assets that need to be financed by bank capital, to 8.5%, which is a Basel III value. It's basically for the bank regulation nerds out there, it's going to be just the minimum capital requirement plus the capital conservation buffer in the United States. In the United States, the CCYB implementation range is from 0 to 2.5%. So basically the board of governors of the Fed can, at any point, well, not at any point, once a year can decide whether this kappa stays at 8.5% or goes all the way to 11%. So, and for a baseline policy, I'm going to consider something very stark. Again, the paper, there's quite a few of robustness regarding these, but for today, it's going to be the stark thing, where I'm going to assume that there's a financial regulator with full commitment that says the capital requirement is just going to be its baseline level if the economy is not in the crisis region. But I'm going to raise it to 11% if the economy ever enters the crisis region and no crisis happens. So this is what is going to be excess aggregate credit growth definition, the BIS definition in this model. And then I also consider some other policy I'm not going to be talking about today. And first question, what are the quantitative effects of the CCYB? And this is what I show here on the black and blue columns. Basically, what the CCYB is going to be a hammer that the financial regulator can use to hit the banks when banks start getting constrained. So banks really want to avoid getting there. So essentially what's going to happen is it's going to reduce bank leverage. It's also going to reduce borrower leverage. So these are the macro-prudential benefits of the CCYB. Because the borders of the crisis region depend mostly on bank leverage, it's going to reduce by quite a bit the probability of a crisis ever happening. So the endogenous probability of the economy ever hitting the crisis region. And it's also going to reduce the severity of the median drop in GDP conditional on a crisis happening. And again, this is because by ensuring that bank leverage is lower, the regulator with the CCYB is also going to ensuring that conditional on crises happen less often, but even if a crisis happens, banks are going to be better capitalized when the crisis starts. So this is going to result where financial crises generate demand-driven recession. So if financial crises are not as bad, the recessions are not going to be as bad either.
Sorry, Mika, you have about 3 minutes left, but there's also a few questions which are building up in the chat. So I don't know if you want to spare a couple of minutes to answer. I suggest you sort of.
Okay, let me see. I'll go open the chat. Okay, first question. Probability of bank run conditional on sunspot shock is exogenous. Well, the probability of a sunspot lighting up is exogenous, but the unconditional probability of a bank run conditional on a sunspot is going to depend on where the economy is and that in what region the economy is. So that's going to be endogenous. Why do I need the exogenous liquidation cost? If I don't have the exogenous liquidation cost in this model, I won't have the multiple equilibrium regions. So there's only going to be two regions, the safe and the insolvency region. And the thing is that in these models, precautionary motives can be quite strong. So typically people will avoid, as quantitatively, it's very hard to make people go to the insolvency region. So at least I couldn't get it to work. And being in the run region without the run ever happening. Yes, that's correct. So my paper is basically a combination of Berkeley Kiyotaki Prestipino and some of my previous work. I don't think they ever talk about that. So that is something that I think is cool that the model does and that they don't have. And finally, regarding household defaults, they're not absolutely essential, but they help quantitatively and they help matching certain things in the data. So sorry, back to the presentation, I'm almost done. So basically what I do is I take the calibrated model and I use the model as a measurement device to estimate sequences of the three structural shocks in the model, the TFP shock, this funding shock, and the sunspot shock. So essentially what I'm going to do is I'm going to ask, what are the shocks that I need to feed into the model so that the model exactly matches the behavior of two aggregate time series for the United States. Aggregate consumption, the trended aggregate consumption in the US, and the TED spread. And to do that, I'm going to use a particle filter. I need to do that because the model is nonlinear. So I basically estimate sequences for these three shocks under the assumption of Basel II, so constant capital requirement. And then I'm going to use these resulting estimates for these shocks, and I'm going to feed them into a model where there's Basel III. And I'm going to ask, how would the behavior of these things have been different? So, and this is basically what happened, quote unquote. These are not exactly what happened, but these are the filtered series from assumption of the United States around the financial crisis, the behavior of the TED spread, which again is the difference between the bank cost of funding and the risk-free rate. And what the model says is that there was a financial crisis in 2008, 2009. And here you have the threshold for whether we are in the run region or not. So if this thing goes above 1, you enter the run region. And you see that obviously because we saw a run, the model says that we saw a run, this thing went above 1 and then declined. Then the blue line is what happens if I take those shocks that I estimated.
You're out of time, so maybe you should move towards the conclusion.
Okay, so basically the only thing I want to show is no run, and UR never goes above 1, so no CCYB is ever activated. And that's it. Thank you very much.
Thank you very much. Sorry for rushing you towards
No, it's fine. My fault.
I'm trying to give everybody sort of the same space. So we can move to the second presentation by Mark.
All right. Okay. So, all right. So can you guys see my screen?
Yeah. Yes.
Okay, perfect. All right. Yeah, thanks so much. It's a pleasure to present here. So this paper is about macroprudential policy interactions in a sectoral ESG model with staggered interest rates. So it's joint work with Kunal Kenner from the Toulouse School of Economics, Tolga Öztürk from the University of Amsterdam, and Tom Stratton also from the Bank of England. And just to mention the usual disclaimer, so yeah, this presentation represents the views of the authors and not necessarily those of the Bank of England or any of its policy committees. All right, now that that's out of the way, let me dive in. This is a two-sector DSGE model, which contains mortgage and corporate lending with a detailed banking sector. And essentially it's based on Clerk et al., which is also known as the ECB's 3 layers of default model or 3D model. So we essentially take that model and extend it along a few dimensions. So what's the motivation for this work? So in in a policy context, what happens quite often is that you get that you have a lot of macroprudential tools. So not only the CCYB, as mentioned by Miguel, but also others. So you have, for example, sectoral capital requirements that only apply to one sector. They can be static or dynamic. You have the CCYB. You have loan-to-value ratios. So they can also be static or dynamic, and then there's a range of other tools as well. And so the idea of this paper is to start creating kind of a workhorse model that allows you to actually look at the interactions of these tools. So essentially, kind of what happens if you activate two tools at the same time? Are there any trade-offs among them? Or kind of what's just like the joint effect? And I'll talk through some of the examples that we find in this paper. So here we have a particular focus on interest rates as the transmission channel. So what we found is that in a lot of the literature, essentially interest rates are assumed to adjust instantaneously if there's a monetary policy change, for example. But we believe that quite a lot of these macroprudential tools work in different ways. So some work more through interest rates, others work more through other channels. And so it's quite important to get those channels right. Otherwise you kind of overestimate or underestimate the effects, and I'll show you later kind of what I mean by that. We also have in the paper an empirically kind of founded section that talks about that in more detail, but here I'm just going to show you like two charts for like a visual interpretation of what this means. So some of the key frictions, so there's interest rate stickiness a la Calvo in the model. We also call that in a la Calvo staggered interest rates. And there's limited liability, bankruptcy costs, and also penalty cost for deviations from regulatory capital requirements. And then, yeah, and so we estimate the model using Bayesian methods based on UK data for like a 20-year period that also covers the global financial crisis. So it's actually going to be quite interesting to see how it differs from the results that Miguel just presented. Okay, so just in case I run out of time, so the main findings are that actually the coordination of macroprudential tools may have a welfare improving effect. Second, that macroprudential tools actually would have improved kind of the state of the economy or some macroeconomic indicators within our model, but it wouldn't have prevented the global financial crisis. And as I mentioned before, staggered interest rates actually do have are kind of important for this transmission of macroprudential tools through the economy. Okay. So just very brief on the literature, as I mentioned, it's the model is based on the ECB's 3D model. There's a strand of the literature that deals with interest rate stickiness. We couldn't find too much on that actually. So if you know any additional papers, then definitely I'd be interested to learn about them. And kind of the two main strands of the literature that this model brings together is like the Bernanke, Goethe, Gilchrist, and Yutaki and Moore kind of strands, respectively. Okay, now on interest rate stickiness. So this chart shows you some UK data for effective mortgage lending rates and effective corporate lending rates. So essentially what this shows you, let's just focus on the left for now, is that, so let's assume you get like a 30-year mortgage, right? And so it's different in different countries. So in some countries like the US, you can actually get a 30-year fixed rate that's constant throughout. In other countries, it's purely flexible, and some countries have like an initially fixed period that then reverts to like a variable rate after a certain amount of time. And essentially, this kind of shows you the situation in the UK where you can get a range of different products. And you kind of see that, not surprisingly, kind of the longer this initially fixed rate is, kind of the longer it takes for the whole stock or kind of based on that, the effective mortgage lending rate to kind of adjust. And we think that's kind of important mechanism that policymakers have to take into account if they want to set a policy or change a policy and kind of judge the effectiveness, or at least kind of think what the effectiveness might be. And we kind of already see here that on the left it looks like for mortgage lending rates it takes a bit longer to adjust than for corporate rates, but I'll show that in one of the following slides. Okay, so this is a very brief overview of the model. And I can't go into all the details, but again, just like to say there's like two sectors, mortgage loans and corporate loans, that kind of the bank can give and kind of internalizes. We have patient households that save, and inpatient households that borrow, and you kind of see here in kind of yellow or slight orange, kind of the different tools that the policymaker has at its disposal to influence the different kind of sectors. Okay, so very briefly on the estimation. So we use UK data from 1998 to 2016, yeah, maybe just to mention, so we have about 33 parameters. So it's actually pretty big and complex model that we are kind of estimating using Bayesian likelihood methods. Okay, so just to illustrate a little bit about the estimation, so I kind of show you here the results for this for these key interest rate stickiness parameters, zeta M for mortgage lending and zeta E for corporate lending. And so just focus here on kind of the mean kind of variable, so or kind of mean number that we estimate. So that gives you the stickiness. So meaning stickiness is higher for mortgage lending than it is for corporate lending. And here on the right, if I just based on that calculate kind of the average duration or the average stickiness, it's about 3.5 quarters for mortgages and 2 quarters only for corporate lending. Yeah, and then this one just shows you the prior distribution and then kind of the results from the estimation of the model. Okay, now let's dive into more of a policy analysis. So I want to show you very briefly 3 different things that you can do with this model and that might be useful for policymakers. And the first thing I want to show you is kind of an optimal policy analysis at the steady state. So for that, we kind of need to define household welfare or kind of welfare, and we do that as kind of a weighted average based on kind of where the weights are the consumption share of kind of the households. So that gives us kind of welfare and or aggregate welfare, and kind of the objective function that we look at is kind of written here at the bottom. So essentially consists of like the level of welfare and a term that kind of penalizes volatility in welfare. So of course, omega is here the crucial parameter. So if you have an omega of 0, then yeah, only the level matters. And then if you have a positive omega, then that penalizes volatility. And I'm going to show you 2 examples going forward. Okay, so this is kind of the setup. And then what do we do? So first, what we do is we kind of optimize each of the different policies individually. So maybe just to mention here briefly, so we have like it's written in the text, and sorry that the slide is very busy, kind of the benchmark policies. So LTV, for example, is at 86%, and kind of the CAR, which is capital adequacy ratio or minimum requirement, essentially, we set at 11%. And then what we do is we kind of optimize each policy separately. And here this table essentially just shows you for an omega of 0 with no weight on volatility, and for an omega of 0.1, what the resulting kind of optimal levels of these policies are. And in brackets here, that's actually welfare improvement. So not the kind of standard deviation or anything, it's kind of the improvement in welfare. And you see for LTV, it's relatively small. And for the others, for the capital tools, it's actually bigger. And just like for the next slide, which is more interesting, just look at the ranges of the improvement in welfare. So here for omega of 0, it ranges between like, 0 up to 2.5% roughly. And then for kind of in the other case, up to like 4.2%. So the more interesting bit is, of course, then what happens if we optimize all the different policies kind of jointly. And then here, so here are the results where we do that for all of them. And so, so first of all, if you look at kind of the welfare improvement we can achieve, then it's actually higher. So it's 8% instead of 7.5% if we optimize it jointly in the case of an omega of 0, and in the case of omega of 0.1, we get 4.8 instead of, I think it was 4.3%. So that's also like an improvement over the individual policies. Now, the interesting bit here, if you look at it, is that actually, so the LTV ratio, there's actually a loosening happening compared to the benchmark. So you can actually, or policymakers should allow banks to extend more credit than in the baseline. But at the same time, kind of the capital requirements increase as well. So I think that's quite an interesting result in that, yeah, you can allow more credit, which has a welfare improving effect. But at the same time, you kind of want to make the banks, the banking system safer by increasing capital requirements. You can actually see that quite nicely in kind of the second kind of exercise I want to show you, which is similar to what Miguel showed us. So it's a counterfactual simulation where we first kind of run the model with kind of the baseline parameter settings. So that's the black lines here. And then we kind of impose the optimal values of the policies that we just established in the previous slide. And we run the model again with these policies in place over that whole period. And then we get the dashed red lines here. And so you can already see here, if you look at the borrowing, like the top two charts, so borrowing definitely does more of a boom bust cycle or more kind of extended credit cycle happening here, which is quite interesting. But I think the key is here on this bank default rate on the kind of on the right here, the second from the top, that actually, given that you have high capital requirements, the bank default rate is actually lower, and that kind of essentially allows you to extend, or allows banks to extend more credit. So that shows up mainly in the welfare of savers who also own the banks. So maybe that's just like kind of a pretty standard way how you kind of close the model, of course, but so in reality, you know, it's maybe a questionable assumption, but it's just like the standard in these models. So most of it shows up in the welfare of savers, less of it shows up in the welfare of borrowers, but a little bit does because they can borrow more and buy more housing and so on. And then, of course, that then is reflected in total welfare as well. Now, the interesting bit here is here at the bottom middle, the output. So that's kind of what I meant with, yeah, overall kind of output improves if we have these policies in place. But when the crisis happens in like 2008, 2009 here in the UK, actually, you still get a large drop in output. Now, to be fair, this is kind of eyeballing it a bit, so I didn't do like an in-depth analysis like Miguel in his previous presentation. But at least if you take this at face value, it doesn't look like you can completely get rid of that. And there might be a bunch of reasons that I can just like speculate at this point, but I'll go into a little bit into more detail a bit later. But one aspect, for example, is that the global financial crisis didn't really start in the UK, so it started kind of in the US, and so maybe we just don't capture spillover effects as well as we can. So, for example, there's no external shocks in this model that might potentially capture that. Okay, so let's move on to the third aspect that might be interesting for policymakers, and that's essentially kind of pretty standard impulse response function analysis. So you can do all sorts of, so we have quite a lot of shocks in this model.
Say that you have about 10 minutes left.
10 minutes, that's more than enough, thanks. So we have this impulse response function analysis, and we can do a lot of different shocks. I think we have about like 10 or so different shocks in the model. And we can apply that, you know, to all the different kind of variables, of course, in the model. So maybe let me just show you to conclude one example here, which I thought was quite interesting. And of course, as I said, you can do this for many more things, and a little bit more of that is in the paper, and you know, there's much more you can do, of course. So what I do here is I look at a bank capital shock, a positive bank capital shock, and I look at the impact of on mortgage lending and corporate lending. And there's two things that I kind of vary here. The first thing is kind of this stickiness parameter, just to show how important kind of stickiness is in this model. So I essentially set it at the level that comes out of the estimation, and then I also set it at just like 0 or really low, essentially mimicking like an instantaneous adjustment in interest rates. And the second thing I vary here is kind of like a policy tool, in this case, a sectoral capital requirement for corporate lending. And the next slide shows it for housing, for the housing SCR. So if you just like look at the left slide here, and so the two lines out of the four, like the two lines that belong together, is like the black and the red line, and that's for the kind of stickiness parameter that we estimate in the model. And then the green line and the blue line, they belong together in a sense that they are with kind of the low stickiness, they're kind of artificially setting it at a low level. And you can see here, what you can see here is if you don't have that interest rate friction, essentially, then you would kind of overestimate the effect on mortgage lending that the shock has. So interest rate stickiness essentially reduces kind of the peak, but maybe extends the adjustment a little bit, and that's kind of pretty intuitive, I think. So we think that actually, as a policymaker, that for policymakers that kind of matters, and so that's why we should put this channel essentially in the model, especially when we look at macroprudential policies. And the second thing you can see here is the distinction between like the standard SCR at 11% and then like a higher SCR of 15%. So that's a 4 percentage point add-on essentially. And as expected in both of these cases, there's a reduction in mortgage lending. So essentially, if your capital requirements are higher, then if there's a bank capital shock, you can lend out less money of that. Well, essentially, and kind of that's why the adjustment is kind of lower in that case. So that's what the red line here and the red line on the right. And so for housing, this looks quite similar actually. I mean, the concrete shapes are kind of a little bit different, but essentially you get a similar pattern that interest rate stickiness matters. So you get like a much larger peak, but maybe the adjustment is a bit shorter lived compared to like when you use the model with the estimated value of the parameter setting. Okay, then maybe let me just briefly move on to the conclusion, and then leave time for questions at the end. I've seen there were quite a few, but I couldn't get to them. So essentially I've talked you through all of that. So let me just focus on kind of the limitations of this model. So in this model, we currently don't have monetary or fiscal policy, and that's kind of, in a sense, inherited from the ECB's 3D model, at least in its original form. And so that potentially kind of explains partly, at least, why we see kind of a drop in kind of output in the global financial crisis as well. So my kind of hypothesis would be if we had kind of active monetary policy and fiscal policy, especially fiscal policy in this model, and we would set that in an optimal way, then potentially you could kind of counteract the global financial crisis, and you wouldn't have kind of this steep drop in output. So in terms of kind of next steps, how we want to kind of develop this model further. So one thought we had is like to put in other macroprudential policies. So for example, loan to income policy, either on top or instead of like the loan to value policy. As you know, the Bank of England has like a policy currently, like a loan to income policy currently in place. So it would be quite interesting to put that in a model and see what the effects of that might be. And then another thought is to put in some learning behavior in this model. So I mean, currently, essentially, it's like kind of this fully rational kind of model, but there's quite an interesting literature from kind of monetary policy with the zero lower bound that actually expectations matter quite a bit, and also like kind of how agents learn about the state of the economy and how they incorporate that into their decision making. And we kind of think that also is important for macroprudential policies. So one potential extension of the model, or kind of a second paper almost, could be to put in some learning behavior into that. Okay, so let me see whether I can now find the questions. Okay, I'm not sure where. Okay, now this is actually, was there any questions for me that I missed? Maybe somebody can.
Miguel, if you want, you can unmute yourself and ask your question directly, if that makes sense.
Yeah, no, my question is very simple. It's just because, so as you showed in the beginning, institutional institutional factors determine, for example, that in the US, it's normal for people to borrow on a 30-year fixed mortgage rate, while if we go to a lot of European countries, like I'm from Portugal, and everyone borrows in a variable as an adjustable rate. So essentially what you're saying is that that type of institutional factors are going to be extremely important for the effectiveness of certain types of macroprudential policies, correct? So you could potentially make them more effective by changing those, by going directly at the stickiness, right?
Yeah, exactly. So that's a very interesting question. Thanks for that. Because so one thing we have observed in the UK is that actually maybe due to the policies that the Bank of England has previously put in place, or for other reasons, that this initial kind of fixed period is actually increasing, or has been increasing over the last couple of years. So even if you don't actively try to kind of get there, it is definitely an interesting factor that potentially might impact kind of the effectiveness of macroprudential policies. And then you're right, and there's a second question, okay, would you want to kind of actively kind of extend the term? But I think that's more like, so it's something we can't really directly, or we haven't tried at least to directly answer in this model. Essentially what you're asking is, okay, if we put in place a policy that would extend kind of this initially fixed period to make interest rates more sticky, would that be kind of welfare improving or not? And I think probably, that's going to be, as always, like, there's probably going to be a trade-off between different objectives, and then it kind of matters kind of what policymakers prioritize in their objective function. So I think that's my guess, but we haven't tried that. But you're absolutely right. Yeah. Okay. Any other questions? If I still have time.
Yeah, you still have like 1 minute. If there's any other question that people would want to ask. If not, then I guess we can move on. Well, thank you very much for the interesting presentation. I think we can move on to Rustam. Can you share your screen?
Yes. Can you see the screen and hear me?
We can see the screen, but I can't hear you very well.
Let me check the.
So I don't know if you want to check the volume of your mic. I don't know whether that's just me or the audio is a little bit low.
I think if you just get closer to the mic, that might work.
Can you hear me now better?
Yeah.
Is it better?
Yeah, better. Thank you.
Okay, it's just the volume. Okay. Okay. So thanks everyone. Thank you, Sylvia, for having me today, and all everyone who is joining. So this paper is titled "The Rise of Credit Market Power: A Missing Link in Macrofinance," and it's a paper about the rise of concentration in the U.S. Banking sector and its implication for the build up to the great financial crisis, and for some trends in macroeconomics and finance. So if you look at the data, if you actually compute the raw indices of concentration in U.S. banking across the board, you will see a steady and significant rise in concentration. So throughout the paper, when I say concentration, I mean the Herfindahl index. The Herfindahl-Hirschman index is a very commonly used measure of concentration. I just take the simple commercial bank data from Compustat, and I compute the HHI for total assets, total loans, 3 types of loans: corporate, consumer, and mortgages, and also for the equity and the deposit side of the balance sheet. And the trend is pretty clear and very stark, that across the board there is the rise of this concentration. Of course, this fact is not completely, it's not new. We have known about it for a while, and the literature has sort of concluded that staggered but persistent adoption of branching laws in the US in the 80s and 90s contributed to these mega mergers and mega acquisitions in the early and late 90s, which led to the creation of these superstar banks, these national champions, Wells Fargo, JP Morgan, Goldman Sachs. They're all basically results of these mega mergers in the 90s. So, and a regulation will played a huge role in it. So there are some papers who argue that these regulatory shocks in the 70s and 80s at the level of the state were pretty much exogenous, or quite the timing of these shocks were exogenous, and the way they were implemented in practice, they were sort of orthogonal to the balance sheet characteristics, or pretty much predetermined with respect to this data. So but again, so this has been known before, and what I'm doing in the paper is I'm doing essentially two things. So I take the rising credit concentration as a stylized fact, as a feature of the data, and I say make two claims. The first claim is that it is sort of interesting that the trend of concentration coincided with some of the major trends in macrofinance that we have observed for the past 40 years. For instance, there is this literature on investment-less growth by Thomas Philippon and many others, the decline in the investment to capital ratio. There is the literature on the decline in the risk premium, and of course, the decline in the real interest rates. It's a huge issue, a huge literature as well. So the first claim that I will make in the paper is that with a novel sort of dynamic general equilibrium model, with monopolistic competition in banking, in the asset side of the balance sheet, and endogenous concentration, I will be able to explain these trends. So I will have a quantitative matching exercise where the model matches exactly these trends that I showed you before, and the model will spit out essentially impulse responses, where the impulse is the rise of concentration, and the response is the transition of investment risk premium and real interest rate, and the transition is between two steady states, essentially, one with low and one with high concentration. And another claim that I will be making in the paper is that if you look again very carefully at the data, the peak of concentration was right around the crisis. So now, and I make the claim that this is not a coincidence. So, and I make a claim that the transmission of regional housing shocks during the crisis depended upon the state of local market, local competition in banking. So in other words, there's this aggregate state dependency of the sensitivity of whatever variable you have in mind, so macro outcomes with respect to the competition in banking. So credit market power, as I call it, can be estimated, and that's what I do. I take branch level data from RateWatch, and I will discuss, of course, in detail what I do with it, but I have branch level data on interest rates and imputed data on quantities, and I'm able to estimate the sort of the structural elasticity substitution across banks. So I'm able to literally estimate the level of competition in the country and for each individual state in the US. So having constructed this index, I'm able to I then correlate them with the different levels of different macroeconomic outcomes during the crisis, and I find that I find a result which is very intuitive and sort of consistent with theory that states where competition is low or credit market power of banks is high, those states experienced substantially worse economic outcomes during the crisis. And I sort of tie this story with the adoption of regulatory shocks in the data. States that adopted state bank branching laws later, they created persistently high credit market power in the state, and so that persisted until the great financial crisis and caused differentially more welfare losses to the consumer. So these are the two sort of pitches in the paper. One, concentration can explain the trend, and also it's important for understanding of the spatial heterogeneity of the responses to the crisis. So I will just briefly mention some of the key papers that I'm building on. So there is a big literature on the banking concentration, but it's surprisingly mostly on the empirical corporate finance part. Very little work has been done until the work by Corby and Derasimo on the linkage between bank concentration and real macro So that's where the contribution of my paper lies. So some of the trends that I will have the model match is again Gutierrez, Philippon, from Liguria. So these are very sort of well-known papers, well-known facts. In terms of the spatial heterogeneity, I built heavily on this idea that bank dependency it's sort of obvious. The great financial crisis was a financial crisis, so the high dependency on bank credit supply sort of resulted in worse economic outcomes. So there is now like this literature using micro bank level or even branch level data. It's developing very fast, and I'm sort of following that. In terms of the modeling approach, sort of conceptually built on the Drexel-Schnabel QGE, and also the model that I have is very similar to Miguel's. So it's essentially a Gettler-Kiyotaki type of environment with monopolistic competition and incomplete markets. And I will talk a lot about it. And finally, the empirical approach is very, it follows me and Sophie's agenda. So I borrow a lot from them. So so the first part of the paper is the goal of the first part is to match these four trends: the decline in the investment to capital ratio, as you can see here, the short-term real interest rate, which is proxied by the 1-year U.S. Treasury rate, deflated, and the decline in the risk premium, which I take from the rate of return on everything, the QG paper by Oscar Jourda and others, and this is the trend in concentration. So yes. So then I argue that the rise in concentration in banking can explain all these trends. So, but I can't answer this question empirically. What I can do is I can create a model, and I can estimate some key parameters from microdata and answer that question. So and the model overview is on this slide. So the key agent in the economy is the financial intermediary. I depart from a huge literature that assumes a homogeneous intermediary, and in my model, the financial intermediation will be endogenously heterogeneous. So I need to make some assumptions. For the bank is otherwise very standard. It takes net worth and invests in firm claims, take deposits. A fraction of the banking sector is monopolistic. The monopolistically competitive bankers, there is the structural elasticity of substitution across them is CES. So it's basically a Melitz sort of setup for banks, right? And this elasticity is constant, and using the microdata, I estimate it. So this theta parameter I can estimate, and it will be around 1.2. So extremely low, very high degree of monopolistic competition. So then I need to assume local decreasing returns to scale. So that's very standard. What the bankers will do in the model, they will charge dynamic markups over the deposit rates. So they borrow from households, they pay the risky deposit rate. They can default with some probability. So the default here is not, there are no bank runs, there's just insolvency. So insolvency happens if they receive if they're very unlucky. So markets are incomplete. They face partially uninsurable idiosyncratic return risk psi. So if they have a lot of negative psi's, their net worth goes to zero, and they just exit. Because there is no deposit insurance for each type of the bank, there must be a type-specific deposit rate, and it's priced competitively by the household. So what is interesting about this framework is that essentially what I'm doing is, and I'm putting Ayagari, I'm putting an Ebuli Ayagari-Huguet type of framework into Gettler-Kiyotaki. So I will have a distribution of banks in the steady state, and for any characteristic of the banking sector, I can compute the ergodic stationary distribution of size, leverage, default. These are new equilibrium objects in this literature. They can be, I can calibrate the model to match them. I can estimate using nonlinear particle filters. I will show you some pictures. So there is a lot to do with them. I won't have time to show the full model. It's quite it takes a long time, and it can only be solved computationally, numerically. So I will just show you the key mechanism. So this is the law of motion of the bank net worth under perfect competition. So it's a very standard equation. So if you're familiar with this sort of macro banking literature, it's very standard. So the banker has some initial net worth, pays deposit interest rates to the household, faces the excess return, and chooses optimal leverage, which is just the ratio of assets over net worth. The total return that the banks get is the partially systematic. Systematic is just the return on the neoclassical aggregate production function. And the idiosyncratic is ER1. And I have some data to calibrate that process. So it's not particularly, as long as I have some idiosyncratic returns, it's fine. So there is a standard problem here. The value function is linear. And of course, for models like Miguel's, it's crucial. So it allows us to achieve aggregation and you can bring in the estimation. So it's not wrong to assume that the banker is homogeneous, but of course, in practice, in reality, it might not be the case. So if I break this assumption, no matter how useful it may be for some models, under monopolistic competition, now we have two things happening. First, we have this dependency on KJ in the excess return formula. So that essentially introduces size dependency. So I can break scale invariance of the model. I can pin down the size of the bank. That gives me the distribution of size. Then the market leverage depends on relative prices. So I have a distribution of relative prices or relative loan rates. I get loan rates from rate watch. I can match the distribution of loan rates. I get the distribution of deposit rates that gives me a distribution of markups. So this is how sort of the idea goes. And if I put theta to infinity and if I put beta to 1, I get Gertler-Kiyotaki. So in a sense, this model nests Gertler-Kiyotaki and Gertler-Kiyotaki nests RBC. So that's a sort of very internally consistent framework. So once you solve the model, you get these sort of smooth stationary distributions of leverage. So I put it in 3 dimensions to show how leverage depends on size. So size is net worth. So banks of high net worth have higher book leverage, which is also what we see in the data. Banks of small net worth have very large default risk or insolvency risk. But as the bank grows larger, it sort of outgrows the risk of insolvency and default risk is basically 0. And again, so these pictures are available for any characteristic. What is important here is that look at if you notice how concentrated these distributions are, so I can exploit this concentration and I can match it. I can take it to the data now. Sorry.
Rustam, just to say that you have 10 minutes left.
Good, thank you. So now let's do the main quantitative experiment in the model. My empirical results will show that theta today in US is 1.2. For now, it doesn't mean much because I haven't explained anything about it, but in the second part of the talk, I will. So let's just assume that I know theta of today. I don't know theta of 1980, but I can use the model to reverse engineer the path of thetas such that it gives me the same rise in concentration. This is what it will look like. So in the first picture, you have the rise in concentration in the data, matched exactly, well, almost exactly. There is some discrepancy here, but it's matched almost exactly in the model. And then we see what the model reproduces in terms of these key aggregates. It reproduces the decline in the investment to capital ratio, the risk premium, and the risk-free rate. The mechanism for that is the increase in the credit market. So this transition for the past 40 years was sort of this painful, persistent rise in market power. So the mechanism is completely intensive margin because there is no, as you have seen, there is no sort of the Mellet's extensive margin is not yet present in the model. I can introduce it, but so it's fully like big banks, lucky rich banks are becoming bigger. Their market power is growing. They exercise their market power by charging higher markups on average every year. That creates a relative, growing welfare losses for the consumer. But what these bankers what they don't internalize is basically that private markups have aggregate consequences. So if you're familiar with Blanchard-Kiyotaki's work, I mean, the aggregate demand externality applies here, but on the side of the banks. banks think that, oh, privately, I'll just, because I can, I will just charge markups, but in the aggregate markups, it reduces demand for investment. And it's sort of, there are a lot of anecdotal evidence that in terms of commercial banking, if you want to get a loan, there is very low competition in a lot of states in the US. And in shadow banking, it's also the case that if you want to buy certain exotic assets, there is literally just one or two traders which are market makers for certain trades that you want to make. An interesting trend also that the model predicts is an improvement in financial stability. That the leverage declines, average leverage declines, and average default risk declines. So this is the competition stability trade-off. So it's basically a very old notion. It's Joe Stiglitz, I think, was the first who started it back in the late 90s, early 2000s. But this is sort of consistent with this literature that says that as credit market power goes up, financial stability improves. So there is a trade-off for policymakers who want to target a big bad banks. But these big bad banks are also they are also the source of automatic stabilization in terms of better financial stability. So that's the sort of the trade-off, and I also talk about it in the paper. So in summary, the rise of credit concentration can explain all these facts. And what I do in the paper, in addition to this exercise, I do constraint efficiency. So I do I set up sort of this social planners problem, and I derive optimal size-dependent policy. So what is important is that because I have a distribution of banks, my optimal policy is bank size dependent. So there is and I have an exercise which shows that if you don't have size dependency in optimal policy, if you just do a homogeneous, say, instrument, you like dramatically miss social welfare. So it is important to have heterogeneous regulation where regulation is targeted by banks of different size and on different profitability levels. And also microfund theta with discrete choice theory, but it's just, it's not particularly interesting. Okay. So the second part of the presentation is to estimate theta, the credit demand elasticity. And I also provide some interesting results which are important in their own right. So I collect data on equity loan interest rates from RateWatch. I focus on home equity loans for a reason which will become apparent on the next slide. I have data on branches and for every US county, for every branch I have data for 5 different maturities, 3 different loan to value categories, and the rest of the data is pretty standard. So the reason I work with home equity loans is because I'm exploiting the housing crisis and I'm using it as a quasi experiment. So I'm using the Mian-Sufirao housing network shocks in my analysis, and I'm estimating the quantity and interest rate elasticity with respect to these Mian-Sufirao shocks. The ratio of the quantity and rate elasticities identifies the reduced form credit demand elasticity. I take that estimate and I plug it into the model, and we're done. So this is the specification around essentially. On the left-hand side, I have either the interest rate or the quantity of a branch in a core-based statistical area and state S. Importantly, I have bank fixed effects, so we take away financial heterogeneity, so analysis is at the branch level. We have state fixed effects, so that takes away state-specific sort of regulation. And also importantly, I control for deposit market power from this paper in the QG by Drexler-Schnabel. So I'm able to identify monopolistic competition on the asset side of the balance sheet, not on the liability side. So I will spare you from big and boring tables. I will just tell you that the average quantity elasticity is 1.36 and the rate elasticity is 1.12. So the ratio of the two gives me 1.2. A lower estimate implies low competition. So potentially structural models with competitive intermediaries could be misspecified, and I used that number to calibrate the model, and and this number is statistically different from 0, but again, it's not different from 1. So again, it's very low, but it's not 0. So, but of course, this is just the average estimate. We can do a lot more. We can construct the spatial distribution of thetas by just introducing state shifters, state slope shifters. Essentially, we run within state cross branch regressions, and for each state will have its own. Each state will have its own theta, and will look like this. So we'll have a map of US, and for each state will have its own level of local credit market competition. Low number means low competition, low elasticity. A high number, which doesn't go more than 1.5 to 3, which is still extremely low. You need to get to a level of 10 in the model to get close to perfect competition. So, that tells you how low competition is on average. So this, but we have some very nice sort of smooth spatial heterogeneity in these thetas. We can do a lot with it. So the first order question is, can this heterogeneity explain economic outcomes during the crisis? And if yes, what is the mechanism? So now is just a simple sort of cross-sectional regression of state level outcomes between 2007 and 2009, and the credit demand elasticity at the state level that I just showed you from the map. And we find that higher elasticities led to better economic outcomes in terms of GDP and employment. Again, high elasticity means high competition. More competitive banking sectors, better economic outcomes, which is sort of very intuitive as well. And also a positive impact on business dynamism. Higher local job creation rates, lower distraction rates in states with a high degree of credit market competition.
Russ, I'm sorry, just to say that you have about 2 minutes left, and there's a couple of questions popping up in the chat. So I don't know whether you want to sort of.
Yeah, I'm done. Yeah. Yes, I was just going to say that. So basically, local competition is good. It affects macro outcomes across the board, and are related to deregulation laws. Sort of the credit market as a power is important, but it relates to sort of this bigger issue of rising concentration in deposit market as well, in deposit market power as well. But there is very little literature on non-interest income, and in the age of zero lower bound, which we're going after COVID, we're going to stay there probably for a long time. The roles of fees as a way for banks to extract rents, it could be very important, but there are not. I haven't seen many papers on that. Okay, so. How do I? Yeah. Wow. Okay. Yes. Default. Yes. Default is endogenous. Default is fully endogenous. Default depends. Default depends on the characteristics of the banks, on the endogenous recovery rate, on your leverage ratio, on how much capital you have. So if you are, so sort of it works out because smaller banks also have high market leverage. So if you get a lot of negative idiosyncratic shocks, your net worth goes to zero, your market leverage goes up, and you are more likely to default in terms of insolvency. In another paper, I'm exploring bank runs, but it's outside of the scope of this model. Yes, entry and exit. It's not endogenous. That is an important next step for the model. But some preliminary results, I find that the number of banks drops in the quantitative exercise, what you also see in the model. But I don't have cyclical entry and exit yet.
So just to clarify, so basically what you do is every time a bank fails, you just replace it with.
Exactly. So okay. The bank doesn't. So the bank understands that but there is no like. Yeah. So the number of banks like in Melis has not been down. But that could
okay.
be interstate banking regulation. That's exactly yes. That's exactly what I do. Thank you. That's how I link it with in the paper. Yes, for the decreasing returns to scale assumption. So I get that question. So there are some papers which find some slight. So I mean, there is a nice paper by Philippon which basically makes the case that for the past 100 years the returns to scale is constant. So it's hard to argue against that. But in the model, I just need I just needed to, essentially, I'm not making a claim on that. It's not a paper about decreasing returns. I just needed to close the model. And so the parameter is very close to unity. It's just to get some concavity sort of in the value function. But I do cite some papers for the EU. There is some evidence that there are big banks are harder to manage. So there is this scope which is costly, but that literature, it's not very robust. Don't understand the last.
Sorry, do you mind? I would ask that you guys take the question
Yeah.
out, so that we allow time for the fourth presentation to take place. Thank you very much for the presentation. We have now Anna.
Yes.
Yes. Hello. Hi. You can share your screen.
Yeah. Let me try. Start. So can you see the screen?
We can see the screen. Yes, it's not in full screen mode, but we can definitely see the screen.
Okay. So now it should be in a full screen.
Perfect. Thank you.
Okay. So good afternoon, everyone. Thanks for the opportunity to present the paper entitled Credit Supply Shocks and Household Defaults. It's a joint paper with Mikhail Mamonov from CRGI and GIMO University. So let me immediately jump into the point of the paper. So this is a purely empirical paper in which we are asking how can positive credit supply shocks cause or lead to further higher default rates on household credit. And we do it on the level of households. So then our analysis splits in two parts. On the first step, we identify credit supply shocks at the level of US states using pretty standard structural VAR procedure and the specification we borrow from Gambetti and Musa 2017 paper. And on the second step, we try to see whether these identified shocks help to predict, to explain defaults on household debt, in particular on mortgage debt, using panel survey of income dynamics database. It's US micro-level database, and we do so with allowing these credit supply shocks to affect with different lags. And what we find is we find a non-monotone effect of credit supply shocks over the business cycle. So in particular, we find that these positive credit supply shocks, which we interpret as better credit conditions, low interest rates on credit and high amounts of loans extended, it can have either negative or zero effect on defaults in the short run at the horizon of 1 or 2 years. But if you consider longer horizon, like medium term, we observe significant positive effects. And it holds both on the period prior to global financial crisis, in particular for the business cycle phase of 80s and 90s, and on the recent period. So I will show you that we have these two periods. And why this is important, as we believe? Well, recently there is a debate in the literature which asks whether boom-bust episodes like crisis and booms could be driven by credit, or it could be explained by changes in expectations. And in particular, there are two views, and you probably know about the influential credit view, which was started by works of Mian and Sufi and co-authors, but it was recently challenged by Kaplan, Mitman and co-authors, saying that, well, maybe it's not credit supply which drives the bombast episodes, but it could be expectations. And our paper could contribute to this debate because we explicitly test the link between the change in credit conditions and further defaults. And also there are some I would say numerous papers testing this link on macro level, in particular like Schleich and Taylor and many others who find that positive changes in credit could predict either financial crisis in the future or recessions. But as far as I know, to the best of my knowledge, you can correct me, it hasn't been tested at the micro level. So that is what we are doing here in this paper. And now empirical strategy, it's I will explain it now in a little more detail. So first we are identifying credit supply shocks, and we do it with a VAR, pretty standard. This is the process for endogenous variables, Y. And we do it for each US state, which we denote as R, region. We estimate this VAR with Bayesian methods because this is the appropriate estimation procedure if you want to use sign restrictions to identify shocks. We impose similar identification restrictions as Gambetti and Musso. They identify for shocks, aggregate demand, aggregate supply, monetary policy, and credit supply, and we do the same with the pretty standard algorithm of sign restrictions. And then we obtain time series of W, which is credit supply shock, like the one that we are interested in. And in our further empirical analysis, I will show you the results with the median, because in Bayesian methods, in Bayesian estimation, you can actually observe all the distribution of those shocks. And in the future, we will try to vary the different percentiles of distributions of the shock and try to see whether our results are robust to it. But for now, we work only with median. Then we take this W, the estimated median credit supply shock, and put it into, which is estimated on the level of R, region or state. In case of US, we take it with different lags from year 1 to year K, like going backward in time. And then we regress the probability of default of individual I who lives in region R, state R, and at time T on this identified shock. And we use many controls, X, individual level controls, and also we have individual fixed effects, region fixed effects, time fixed effects in our model. And this is, we call this a direct specification, like just credit supply shock and defaults. And then we also tried kind of 2SLS procedure in which we first regress the individual debt level on the credit supply shock, and then use the predicted level of debt, of indebtedness. We have different indicators here, like a real level of debt, of mortgage debt, debt to income ratio, different indicators of debt, and then we regress defaults on these predicted debt indicators in the second specification. Now, data for structural VAR analysis, we use 5 5 variables VAR, and we try to reproduce variables from the Gambetti and Musso on US state level data. So it's a proxy for GDP, prices, sorry, in case of risk-free rate, lending rate on state level, and the amount of loans issued. Then for the micro level data, we use panel study of income dynamics. And unfortunately, this data is quite scarce, so we don't have access to some fancy and nice data. We use this public data. And the data on defaults or on defaults is not regularly there. That is why we use 2 subsamples. First one covers data prior 1996, and there was a question in the data in which they asked whether households had default in 1996 or before. So there is a year of default during these 20-25 years. And there is a second, and then this data was discontinued. And then there is a second span, which starts in 2000s. And they started to ask a question whether household is behind the mortgage and for how many months it is behind, or whether it has mortgage restructuring occurring now. And we use this data, and also we collect data on several control variables like employment, race, home ownership, and many others, which we mostly borrow from Mian and Sufi paper. With that, I will first show you the estimated credit supply shock. So here on this graph, you can see the first time variation in this shock, and second, the state variation, because with this black line stands for 50th percentile in the distribution of states, and the dashed line covers the 25th and 75th percentile in the state distribution of the shock in a particular year. So you can see that there is some heterogeneity, but at the same across states, but at the same time there is a stronger movement in time. And what is important is that all those movements have quite clear economic interpretation. In particular, there were positive credit supply shocks in the early and mid 80s, which then ended in the negative credit supply shocks. Normalized that if the value is above 0, it means that more credit at better terms is extended. Then it's around 0, and there are also some spikes in the mid 2000 and this sharp decline around the global financial crisis. So here it was like savings and loans crisis. Here we have kind of maybe dot-com bubble around the end of 90s, and this is the mortgage boom and bust in 2000s. And we use this series. In particular, in further estimations, I will focus on positive shocks only, because our main hypothesis is that positive credit supply shocks today can induce these boom bust features in the data. So it can be good today but bad tomorrow in a way. And yeah, it's just
to say they have 10 minutes left.
Okay, thanks. So here is the estimation results. So the dependent variable is the incidence of the delinquency on mortgage households for at least 1 month. And the main explanatory variable which is presented here is the positive credit supply shock. And we take it with different lags. And in 2000s, the time of frequency of PSID is 2 years. So that's why lag 1 unit means that 2-year lag. And from this table, you can see that, well, actually, the deeper the lag, the stronger the effect is. And the sum of all lags is also significant and enters with positive coefficients, no matter which controls we have, like household level controls, fixed effects, different fixed effects, with the exception of year fixed effects, because if we include them, it seems that they kind of absorb the time evolution of the explanatory variable. That is why we do not treat this column 6 as the main one. And if we try to vary the dependent variable from being 1 month behind on the mortgage, because it can occur just randomly, so it's of course not a default. We also try 3 months delinquency, which is in international classification. It's a proxy for non-performing loan. So this loan can be treated as a non-performing. And here you can observe that, for example, small lags of positive credit supply shock enters with negative sign, meaning that if the better the credit terms 2 years before actually decreases the probability of default in the short run, but increases in the medium term. Then we also do this two-step approach, two-step exercise. And on the first stage, we try to predict the indebtedness indicator. For example, in that case, this is mortgage debt to income with the lagged credit supply shock. And here, again, sum of all lags is positive and significant, meaning that if more credit is extended, each household on average will have a higher indebtedness ratio. And on second stage, this predicted value leads to higher probability of being behind mortgage for 1 or 3 months. Doesn't matter here, I think for 1 month. But in the robustness check, in the paper, we have it for 3 months. And we also have here many controls and fixed effects. And here we were working with 2000 subsample. Again, because the data is quite scarce. And we also tried, we could not actually reproduce the same exercise with the 80s and 90s subsample, and that is why it's a little bit different here. Yeah, first, the difference is that data is annual. In this subsample, 79, 1996. And again, we have here I have a direct effect, and in which credit supply measure enters directly in the equation of the probability of default. Here I should say that the dependent variable is not being behind on mortgage, but the event of default, which is actually in the data up to 1996. And again, negative and insignificant coefficient for short lags, and positive for 3, and 4 in the two-stage procedure, which is in line with our expectations. So then, how many minutes do I have?
You have 4 more minutes.
Okay, so let me now then briefly show you the one more exercise, and I will move to the conclusion. So we actually, again, given the data, we also tried to do a kind of event study exercise in which we focused on a particular episodes of well-interpreted positive credit supply shocks, and in that case, in the pre-1996 data, it was like the savings and loans crisis, in which we have like the peak here in the shock series for most of the states. And we traced how this household defaults were behaving after these events. And to do that, we just ran these simple regressions in which we had different years, and we could trace the effects for different in year T+1, T+2, T+3, etc. And you again see that after the event of a positive shock, we observe a negative coefficient of defaults year after, but it becomes larger and eventually becomes positive with 3 or 4 lags, which again confirms the previous results. Then I'm moving to conclusions. So we are thinking to take explicitly uncertainty about estimated shocks. We're working now on the revision of the paper. That's why all comments and suggestions will be highly welcome. Then we would like to control actually for negative shocks, because for now we are focusing only on positive ones. And it would be interesting, we think, to look at cross-sectional differences in the effects of shocks, because households in different distribution of income or wealth could actually be affected differently. And to conclude, we do this analysis, like we try to estimate how household defaults respond to positive credit supply shocks, and we find that indeed these positive credit shocks today can sow the seeds of future crises, and this effect is there on microdata. It could be support for credit-driven explanation, and also for the recent theories of endogenous business cycles. Thanks. I will check the chat if there is something. Oh, sorry. And if you could.
There's nothing popping up on the chat. I'm going to ask participants if there's any comment on the paper or any question. Otherwise, I actually had a couple of very quick comments. So one is, what is the rationale behind the fact that you only focus on positive and non-negative, and whether you think there's some fundamental asymmetry that you have in mind? And also, it seemed that the effect, well, the timing of the effect was sort of changing depending on the specification. So whether you had any comment on that?
Thanks for the question. We were focusing on positive shocks in this analysis, and we thought that positive shocks in the recent view, in all those Mian and Sufi papers and Shularik and Taylor, they actually bring this idea that the better today could be not good tomorrow. So that's why we like exploit this idea. And for negative shocks, I think this non-linearity would not pop up, but we should test it explicitly. I think that for negative shock, it would be just, you know, if there is a negative shock, we could be more likely to be in default or in recession. While for positive, yeah, there is this nice nonlinear feature, and I think this is an interesting question in a way. And for the timing, most papers which I saw, macro papers, they found that this nonlinear, let's say, effect, that positive shocks or positive or too much credit predicts the subsequent crisis. This effect actually materializes at the horizon around half duration of business cycle, like 4 or 5 years. And I think our results are consistent with this. And yeah, we in most specification we find this effect at the horizon of 3, 4, 5 maybe years. Yeah, thanks for the comment.
Okay, thank you for the presentation. We are ready to move to the last presentation of today, which is by Dimitri. Do you want to pop up your slide?
Yeah. Anna, you need to stop sharing the screen before I can share mine.
Let me switch it off.
All right. Oh. So we should be good to go. Let me... All right. Thank you. Thank you for having me and organizing this event despite all the circumstances. This project has to do with the relationship between housing market cycles, household indebtedness, and medium-term economic fluctuations driven by productivity growth. Now, the starting point of this project really is the well-documented empirical observation that recoveries from financial crises tend to be slow and incomplete. Perhaps the most well-known example of that is the dynamics of the US economy post-Great Recession presented on the left. However, this is by no means is specific to the US economy and the Great Recession period. There is a variety of explanations offered by the literature. This project specifically focuses on the role of housing market cycles and home equity borrowing in generating these such persistent effects of recessions. Well, this particular focus is, the motivation for this particular focus is kind of twofold. One is specific to the Great Recession and the role of the housing market, the important role of the housing market in the US economy at the time and in some other advanced countries alike. But broader motivation would be just important role that the housing market just by its sheer size that it plays in advanced economies mostly, and as such its interrelation with the macroeconomy is interesting and important. So in this project, I first, there is an empirical part of it and the modeling exercise. I first document some novel stylized facts on the relation between housing market cycles and growth. And then in the second part of the paper, I interpret these empirical observations through the lens of a dynamic general equilibrium model that allows me to speak to the important channels and perform some counterfactuals. So let me jump into the empirical part, which, excuse me, the empirical part of the paper relies on a comprehensive cross-country panel that combines the data on house price dynamics, private debt, and a variety of macroeconomic indicators, and an index of utilization adjusted TFP that I construct following some approach offered by the literature from before. The main message from the two exercises that I conduct is that housing market boom and bust cycles in the medium run predict a persistent shortfall in the level of GDP, and which seems to be primarily driven by slowdown in GDP growth. And this observation, again, is not specific to the post-global financial crisis period. There are two empirical exercises. The first exercise uses a panel VR to illustrate the effect of house price shocks. This model is quite simple. It includes three variables: utilization adjusted GFP in log, household debt to GDP ratio, and a log of real house price index. The house price shock in this model is identified with short-run restrictions with the house price index ordered last. So the assumption is that the dynamics of the house price shocks do not affect the broader economy, the other two variables, within the same period, within a year, because the data is annual, which is kind of an assumption similar to the ones people made in the literature before. Now, what you can see on this slide is a response of the system to a 1% positive shock to the real house price. So in the short run, this positive shock to the house price causes an accumulation of household debt and no significant effect on the GFP level. Over time, however, as the house price dynamics reverses, so does the dynamics of the household debt. And in the medium run, these predict a persistent decline in the level of GFP. So this is kind of the first takeaway from this simple exercise. As a second exercise, I take a closer look. I adopt sort of an event study and take a closer look at specific events of explosive house price growth and its subsequent equally large corrections in the data, of which I identify 63, more than half of which are from before the global financial crisis. Again, so the results that are going to be showing are not driven specifically by the post-2007 world. So I then, having identified these 63 events, do a kind of local projection type of an estimation where I regress the cumulative growth of various macroeconomic variables of interest on the measure of the house price decline during these housing market crashes, conditioning on fixed effects as usual, country trends, and set of macroeconomic indicators that control for some pre-existing macro conditions at the time of the housing market crash. Now, estimating this relation of different horizons gives us a set of betas that can be stacked together and interpreted as a dynamic response of variables, which you can see on this slide. So the resulting responses are as follows. Housing, this sharp decrease in house prices during the events of study are associated with household deleveraging in the short run, the decrease in household debt to GDP ratio, and the decline of economic activity, the levels of real GDP and consumption not only take a large hit immediately, but also exhibit quite a persistence. And in terms of the growth accounting decomposition, looking at the responses of labor, capital, and GFP, we can conclude that according to these responses, a lion's share of this persistence in the dynamics of output and consumption is likely to be coming from the persistent shortfall in the level of utilization adjusted GFP. So housing market crashes, according to this evidence, are associated not only with the significant decline in economic activity on impact, but also with a quite persistent responses of variables, similarly driven by the decline in TFP growth in the medium run. And this is the evidence that I attempt to interpret in the second part of the paper through the lens of a general equilibrium model that allows me to provide a structural interpretation of this empirical evidence, and specifically the results of the event study that I just showed you. Now, the model builds upon, it's a new Keynesian model, so it's builds upon a conventional quantitative new Keynesian model with capital accumulation, extending it into 2 dimensions. Well, first, it's a tank model. So there are 2 types of agents, similarly to what we've seen before. Today, there are borrowers and savers, 2 types of households, borrowers and savers, which roles are determined by their relative patience. So borrowers are less patient, lenders are more patient. Both of these households hold a durable good, housing, which generates a utility stream for them and plays a role of a collateral for borrowers. Borrowers are subject to an occasional and binding collateral constraint. And the second dimension in which this model is being extended is that it includes the endogenous growth mechanism. So growth in this model evolves, productivity growth evolves endogenously through introduction, through a forward-looking investment into introduction of new intermediate products in the Romer type of endogenous growth model. And let me, for the sake of saving time, I'm not going to go into deep details on the model because most of its features are quite conventional, but let me briefly elaborate on the 2 components, housing and the endogenous growth part. In a simplified manner.
Just wanted to say, because we're running like slightly behind schedule, like you have around until around 5:35, well, 35, so 12 more minutes.
All right, yeah, that should be fine. So the endogenous growth part, again, as I said, it's a Romer type growth that stems from an ever-expanding set of intermediate products in the production function. The new varieties of intermediate products are invented through innovation, for innovation spending, and in aggregate, there is a positive externality in innovation. So the more of these intermediate products there is in the economy, the more productive the innovators are in aggregate, which brings about the possibility of unbounded growth in the model. The reason why there is an incentive to invest into introduction of new products is because there is monopolistic competition. So these intermediate products are imperfectly substitutable. So an inventor and an owner of intermediate product gets a positive income, a positive profit stream in the future. So it gives an incentive to enter this market subject to an entry cost, which is the need to invest into introduction of this product to begin with. So this positive income stream, positive profit stream from innovating gives us the link between cyclical conditions that affect profits and incentives to innovate and medium-term growth. So there is this link between cyclical conditions and growth through cyclical conditions affecting incentives to invest in innovation and into things that improve productivity in the medium run. As for housing, it enters the model in 2 parts. Housing is a durable good that generates utility for household and is subject to a housing preference shock, which is going to be the main driver of the house price dynamic for my simulation. And the existing literature, well, at least part of the existing literature points out that this housing preference shock or housing demand shock is the key disturbance for generating the empirically relevant sharp swings in house prices. So housing also plays a role, as I mentioned, a role of a collateral for borrowers. So borrowers are the amount of borrowing that they can engage in is capped from above by a fraction m of the total housing value that borrowers hold. And this is an occasionally binding constraint, so the economy may or may not be in the financially constrained regime depending on prevailing macroeconomic conditions. Now, if the constraint is binding and the Lagrange multiplier with respect to the constraint is positive, it introduces an intertemporal distortions in consumption, savings, investment decisions in this economy. Well, which is going to be important for the dynamics in my simulations. So the main experiment that I conduct is to subject an economy to a series of negative housing preference shocks, which again, I follow the literature using this shock to generate the sharp swings in house prices. And this series of negative housing preference shocks is such that it causes a collateral constraint to bind and triggers household leveraging in this economy. And the magnitude of these shocks and the number of shocks in time is such that to replicate the empirical house price decline during the event study from earlier. Now, the calibration of the model follows the literature to the extent possible, and I use some existing empirical targets in my calibration, but I also, it's a quantitative model, I also use impulse response matching to estimate several quantitative parameters. So the impulse response matching involves the choosing parameters to minimize the weighted distance between the model generated impulse responses and the movement of variables from the event study from before. And you can see the resulting impulse response model produced impulse responses superimposed on the results of the event study from before. So overall, the model does a good job in fitting the data and replicating this persistence in the dynamics of output and consumption, and the endogenous decrease in the measured TFP is key for generating this data relevant persistence. Now, the model allows me to formally decompose the dynamics of output and the measured TFP, the solo residual, which further emphasizes the role of this endogenous response in innovation for generating this medium-term decline in TFP and generating persistence in output and consumption. Also notably, the dynamics of the solo residual is driven by different factors at different horizons. So in the short run, the solo residual is driven primarily by the time-varying factor utilization and a markup distortion in the intermediate product sector. As the time passes, the true decrease in TFP due to the shortfall in innovation spending kicks in and is key for generating these longer-term dynamics. Now, the model allows me to identify and illustrate and highlight the four main channels that drive the dynamics, that propagate the series of negative housing preference shocks, housing demand shocks to the broader economy. First of all, when these falling house prices cause a collateral constraint to bind, it triggers deleveraging, which propagates as an aggregate demand shock, similar to what we've seen in previous presentations today. It propagates as an aggregate demand shock, given that there are nominal rigidities in the short run. In the presence of this endogenous growth mechanism, an endogenous slowdown in TFP growth emerges as a second adjustment margin, and it operates in the medium run and prolongs the effect of the shock and generates this empirically relevant persistence. Now, these two key channels are amplified through the third and the fourth channel. The third channel being the Fisher net deflation, this negative feedback loop between private deleveraging and aggregate collateral prices. So today's deleveraging decisions of private agents cause aggregate collateral prices to fall and trigger more deleveraging. The problem is this pecuniary externality that private agents do not internalize the aggregated consequences of their deleveraging. And the second amplification channel is kind of novel, if you will, which arises due to the presence of endogenous growth. I label it the expected income growth channel, which involves the negative feedback loop between expected growth and current spending. So agents expect growth, productivity growth to fall in the future, so they expect their income stream to be lower in the future, and then adjust their spending through intertemporal substitution today as decisions of private agents. In aggregate, these, however, additionally feeds into slow innovation spending and growth dynamics in the future. Now, these two amplification channels reinforce each other, and their magnitude, as I show, is very sensitive to prevailing macroeconomic conditions and macro policies. Which brings me to the last couple of concluding remarks that I would like to make for the purpose of this short presentation. The first point relates to, well, this slide shows the counterfactual responses of the economy under different initial household debt to GDP levels. So the baseline calibration is such that household debt to GDP is around 55%, and then the two other responses over here to counterfactual responses show the counterfactual scenario of the 25% and 95%. So what you can see here is that in general, that suggests that more indebted economies are more susceptible to the type of their deep crisis, slower recovery with a shortfall of productivity, large shortfall of productivity in the medium run type of dynamics that I talked about today. The second in the last remark that I would like to make relates to the conduct of monetary policy. As usual, it's an NK model, so the nominal interest rate is governed by the Taylor rule, with some weight put on the cyclical deviation of the inflation rate from its long run level, and some weight put on the cyclical deviations of GDP from its long run trend. Now, an interesting question that I addressed is how the welfare cost of the crisis scenario that I conduct varies depending on various parameters of the Taylor rule, depending on the various weights that the policymaker puts on inflation stabilization versus output stabilization. And what I show, so basically I simulate the economy under different parameters of the Taylor rule, and they calculate the welfare costs, which allows me to plot this nice heat map. Which shows that the welfare cost of this crisis scenario, specifically to borrowers, in general, borrowers bear a greater burden of the welfare cost of this crisis, and it's quite sensitive and mostly sensitive to the Taylor rule response to output, short-run output deviations, and puts a greater weight on inflation stabilization in the short run. Does not help to alleviate the welfare cost of the crisis, and even in some under some combinations of parameters, it may be welfare reducing. So as a
just to say that time is up, unfortunately.
Yep. That's perfect. That's my last slide, actually. So the short takeaway for policymakers is that a greater the greater focus on output stabilization may be useful in alleviating some of the short-run and persistent effects of the crisis scenario that I that I studied. There are some multiple more results in the paper which I did not get into, but the broad takeaway from what I've done, I think, is that housing market crashes are transitory events, but they can leave a long-lasting scars on economic activity through endogenous affecting productivity and growth. But there is some hope that properly designed policies, both in fiscal, in monetary policy dimensions, can help to alleviate some of these issues. All right.
Thank you very much, Dmitry. Thank you very much, everybody. I'm afraid I'm going to ask questions to be taken offline because we are slightly beyond our time allocation. So I just want to thank all the presenters and all the organizers for putting together this very interesting session. Goodbye to all of you. Enjoy the rest of the conference and see you around soon, hopefully. Bye all.
Thanks.
Thank you. Bye.
Thanks.
Bye.
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 Thank you. Bye.